Hi, and welcome back for the second part of Taxation of Divorce. I know you have been anxiously waiting in your seat to find out what the newest and one of the most controversial issues of the new tax bill has been for alimony, and some of the biggest issues that there are in divorce being property settlement and how that can affect the different spouses in a divorce. So with no further ado, let's get started. So to begin, the new Tax Act does not make alimony deductible anymore. The old rule used to be that alimony was deductible by the payor, and the person receiving that alimony had to include that in their income. And this being the idea that if you are not using that income, it's being given to another, then you should not be taxed on that. The person who is being treated as if this is their income should be taxed on that income. Well, in 2019, that is not the case anymore. So you better get a divorce in 2018 if you are even contemplating it, because if you think that you're going to have to pay alimony, you're going to want to have your spouse, your future ex-spouse, pay for that income that they are receiving in alimony. For example, 361,000 taxpayers claimed that they had to pay alimony in 2015 for a total of $9.6 billion in alimony. However, what's unique is that only 178,000 taxpayers claimed that they received alimony. Odd in that double that claimed that they had paid alimony. That's why the IRS in particular, but Congress also wanted to be able to claim that income that was not being reported by nearly half of the recipients of alimony. So now let's go back then to 2018 and prior. So this tax season as well as next tax year. It is deductible by the payor, and it is includable by the payee, or the person receiving that alimony. Payments under a post-1984 agreement are also alimony if payments are in cash, the agreement does not specify that the payments are not alimony, and there is no liability to make the payments for any period after the death of the payee, or the person receiving it. Some examples of this last point are on the right side of this slide. Now let's talk about front-end loading alimony. What is this? Well, when drafting alimony agreements, there are a couple of different ways in which you can do this. You can do a level amount of alimony that lasts until the person dies, or lasts for the years that the marriage had commenced. Well, that's one way of doing it, but that doesn't really stop somebody from just living off of that alimony and not going anywhere with their lives, especially in a shorter marriage. Then there are recuperative alimony agreements or stepped alimony agreements. And this is typically when you have an arrangement where there's a stay-at-home mom who didn't get a career and they had only been married for a 5, 8, 10-year period of time, where it starts high and then ends low to encourage a spouse to go and get a job or go get skills to be able to get a good job. And so in some instances, you have a situation where there are steps. In a period of years, it will go down by $10,000 per year, or it will go down by $50,000 per year depending on the marriage. So in these instances where it's recuperative, we call this front-end loading alimony. And the issue becomes if amounts decrease by more than $15,000 per year, then you have a calculation where you then have to recapture income to the payor, who then has to be taxed on that income. And so here are the steps to calculate front-end loading alimony. take a screenshot of this because we're now going to go into an example so that we can discuss what this means. How does this actually apply in a real life situation? So in this example, let's assume that husband has to pay alimony as follows. The divorce decree says that in year 1, he must pay $85,000. In year 2, he must pay $55,000. And in year 3, he must pay $25,000. So the first thing that we do is we ask ourselves, is there a front-end loading alimony issue? And the answer is yes. The difference between this is definitely greater than $15,000. So front-end loading alimony? Absolutely yes. Now, if so, how much is recaptured in year 3? So we have to go through our steps. And the first step is that we take, so step 1. We take year 2 alimony of $55,000 and we reduce that by year 3 alimony of $25,000. And that leaves us with $30,000. Now step 2, the $30,000 is reduced by 15. So step 2, the $30,000 is reduced by $15,000. This $30,000 being what we calculated from step 1. And then we have $15,000. Now let's go to step 3. So now for step 3, we take year 2 alimony of $55,000 and we subtract the amount that we calculated from step 2. And that gives us $40,000. Step 3 is that we average the year 2 alimony amount that we calculated in step 3 with year 3 alimony of $25,000. We're going to add these together. That gives us an amount of $65,000. And we divide that by 2. And that gives us $32,500. Now, in step 5, we subtract the average that we came up with from step 4 of $32,500 from year 1 alimony. So now we take the $85,000, we subtract the $32,500, which is from step 4, and that gives us $52,500 for step 5. Then in step 6, we subtract $15,000 from this amount. So we take the $52,500 from step 5 and we subtract $15,000, the amount of alimony recapture that is allowed. So that gives us the amount that is allowed before we start getting into front-end loading alimony recapture, and that gives us $37,500. So step 7, and we're almost done. You take the $37,500 that we calculated in step 6 plus the $15,000 that we found in step 2, and you add those two amounts together. And that gives you a total recapture for year 3 of $52,500. So in year 3, the payor must pay tax on $52,500 because that amount was considered front-end loading alimony, thus reducing his taxes over the last couple of years in more than the amount that the IRS and Congress decided was allowable. Okay, so that is front-end loading alimony. If the numbers are larger, if there's more alimony, this alimony recapture is exponential. And you do this for each year that there is alimony that is done in this step-like fashion where it's reduced by $15,000 per year. And so you would then have a year, then have a year 4 recapture, a year 5 recapture, a year 6 recapture, always looking at 3-year increments. Okay, so now let's go to property division. Code section 1041 makes property division non-taxable, and typically the courts like to split this equally between the two parties. Each spouse takes over the basis of whatever the property was valued at the time of purchase. The issue becomes when you're dividing businesses. There can be some really serious consequences. And so now we're going to go over another problem that is very dear to my heart, in that this happened to a client of my firm's, where all of a sudden there were disastrous tax consequences dealing with either of two possibilities for property division. So the names are not mentioned, the type of business or industry is also not mentioned, and as they say, the facts and circumstances have been changed for the privacy of the parties. Whatever, I was trying for a joke, it didn't work. Okay, so husband owns a law practice worth $1 million with a basis of 0. There are no other assets. Because his wife is not an attorney, she cannot own an interest in the practice. There are 2 options for property division: a note to the wife for 50% of the law practice, or 2, sell the practice and give wife 50% of the value in the practice. So what are the tax consequences of each option? And let's talk about it. So in scenario number 1 of providing a note for $500,000 to divide the amount of the $500,000 into equal increments, making it easier for him to pay that over a period of time, and allowing husband to be able to keep his law practice. This being because wife cannot own an interest in the practice. Under most state law, you cannot own an interest in a law practice if you're not a lawyer. It can cause ethics issues, etc. However, husband doesn't get a step up in basis, remember? So husband will have to make payments on the notes which are not deductible. So assuming that husband makes payments on the note where we are considering future value and present value, we're looking at if he takes 10 years to pay it off, and we have an 8% interest rate, he's going to have to make payments yearly of $74,515. But this is not the only thing that we have to consider. He's also had children, and therefore he has to pay child support. Also, his wife is, let's assume she is a stay-at-home mom, and she supported him over the last couple of years. By being a stay-at-home mom, she's also going to be paid alimony. So now let's assume that he makes $200,000 per year. If husband makes income of $200,000 per year, he's going to be ordered to pay $100,000 of that in alimony. So we're going to reduce that by $100,000 for alimony. And he has to pay $12,000 a year for child support. These are just random numbers. Child support. Now, alimony and child support are calculated by courts typically before tax. So alimony will be deductible, but child support will not. So husband will have to pay $19,000 in tax. $19,210 based off of my calculation. So now after taxes, alimony, and child support, husband will have $68,790 to live on. But let's remember, he owes his wife the $74,515 for property settlement because he is paying these over a 10-year period of time. Well, guess what? He now is going to have a negative $5,725 per year to live on. Well, he's going in the hole every single year. At some point, husband won't be able to live, even though he's slaving away in his law practice. Now, that's option number one. Let's go to option number two. So option number two is that he sells the practice. He's like, sorry, I'm not going to live off nothing and go in the hole for this. Instead, let's just sell the practice because I'm not going to be a slave for you. So he sells the practice. His sales price is $1 million. That's sales price. Well, but his basis is zero. So he's going to have income that he has to pay tax on of $1 million. And let's assume that his federal tax rate in 2017 is 39.6%, and let's assume 10% for state tax. In total, he's going to have to pay $496,000 in taxes. He then has to pay his wife $500,000 in property settlement because guess what? They get 50-50 according to the law, and so based off of his property settlement, he then is going to be left with $4,000 to his name, and his wife will receive $500,000. This is absurd. This man just spent most of his life developing this law practice that he has slaved in. He now has just sold it to be able to provide for his wife in her property settlement, but now he has to go back to work at some law firm making about the same amount of money because he most likely can and has the ability to, and then he will have to continue to make payments for alimony as well as child support in the future. And those payments for alimony are not deductible according to the new law that will be imposed in 2019. So what do? The way that we deal with this is that we deal with property settlement on an after-tax basis. It's not typically demanded by the courts, but it is in the best interest of you as the taxpayer and your client if you are an attorney. And this is why most husbands will abandon their obligations for alimony and child support because they just financially cannot support it based off of a before-tax analysis. Generally, it is in both parties' best interest for husband to continue working and to continue paying alimony and child support. And so just do your best to do an after-tax analysis. Consider the fact that those taxes are going to have to be paid, so those dollars aren't on the table. That's how you negotiate a property settlement after tax. So now let's go into quadros or qualified domestic relations orders as a part of property division. So the general rule when pulling out money from retirement is that there is a 10% penalty on premature distributions. However, there is an exception that distributions made pursuant to a quadro are not subject to that penalty when they are rolled over into another qualified plan. It's well settled that present value, as well as any deferred earnings accrued during the marriage, are marital assets, and therefore retirements are divisible as a part of a property settlement. However, the issue becomes that the value of the retirement should be determined at the time of divorce if it is determinable, because sometimes it's not determinable depending on what type of retirement that you have. So therefore, care should be taken so that the retirement benefits are not necessarily split. And a lot of courts will award more alimony based on the husband's receipt of his share of the retirement benefits at the value that they are at the time of the divorce. Typically, cashing out from other marital property is a preferred method of dividing retirement benefits because the long-term and deferred sharing of financial interests is obviously too susceptible to continued strife and hostility, circumstances which the courts traditionally strive to avoid to the greatest extent possible. So the best way to accomplish division is a present value of a pension if it's ascertainable, and by dividing the other assets, leaving the pension benefits to the employee himself. Now, in some instances where marital assets are sparse, income is low, and an award of an equitable share of retirement assets might work as substantial hardships, courts have awarded the value of assets on a periodic payment plan, and in some instances have provided for payments when payout begins. But again, this is a long-term entanglement and a lot of spouses will cut and run. So there are a couple of options that you can use to determine how to divide the retirement benefits through a quadro. And the first being that you give the other spouse the present value of his or her share. So the court can order the payment of a present value of the other spouse's share over a period of time. For example, a physician in Utah was required to pay 1/2 of the net present value of his retirement plan of $50,000 to his former wife in 5 annual installments. The court awarded the present value of the share to be paid within 5 years to avoid leaving the parties in a financial entanglement that would continue for approximately 20 or 30 years and would probably result in further court hearings and cause future animosity between the parties. Another is using other assets to offset the share of retirement benefits. So while the best method for distributing or allocating retirement benefits or their value depending on the particular circumstances, it is preferable to end the marriage and allow the parties to make as much of a clean break from each other as is reasonably possible. So by fixing the present value of the other spouse's share of the pension plan and satisfying the other spouse's share out of other assets, you then leave all the pension benefits to the employee. You can definitely do this, and this is a really good option when there are sufficient other assets for an equitable distribution and a present value of the retirement benefits can be established. But then another issue is the interest on the premarital portion. So the issue of accrued interest on the premarital portion of the retirement account must be analyzed pursuant to general rules regarding premarital property and separate property. The general rule is that equity requires that each party retain the separate property he or she brought into the marriage, including any appreciation of separate property. There are exceptions to this general rule, though, including where the property has been commingled. So where the other spouse has been, by his or her efforts, augmented, maintained, or protected the separate property, and where the distribution does not achieve a fair, just, and equitable result, you can include interest on the premarital portion if it was commingled. Okay, so I know that was a lot of information, and I hope this was really helpful for you. If you have any questions, feel free to leave a comment in the comment box below, or if you really liked this video, please also also leave a comment. I love to know what it is that you all want to hear when it comes to these types of videos. If you have questions as well, you can email me at centerfortaxstudies@gmail.com. Please subscribe and like this video if you did, and we'll see you next time.